Good morning and welcome to the Retiree Benefit Trust Committee meeting on Friday, August 27th. We are starting about 11:05. Apologize that we're starting a little bit late. We are in the Chesapeake building of the St. Mary's County Government Complex in Leonardtown. Joining me today, I'm the chair, Rebecca Bridget, and on my left is Jeanette Cudmore, CFO, Commissioner Mike Hewitt. On my right is Marianne Murray, our community member, and Catherine Pratson, our HR director. Also joining us, thank you, is Michelle Rance, our administrative member for today, and Jody Quasney is joining us via Zoom. Welcome, Jody. And Amy Carter is our videographer that tapes the meeting. Thank you, Amy. So we'll go ahead and get started with our roll call for approval of the agenda, please. If you take a minute to review the agenda, and then I'll entertain a motion to accept.
I'll make a motion to accept the August 27, 2021 agenda.
I'll second.
Thank you. We have a motion and a second to approve today's agenda. Any discussion? Hearing none. All those in favor?
Aye.
Any opposed? Motion carries. Item 2B is the approval of the meeting minutes for July 22nd, 2021. If you take a minute to review, then I'll entertain a motion to approve, please.
I'm going to make a motion to approve the minutes of the previous session.
We have a motion on the floor. Is there a second?
I'll second.
Thank you. We have a motion and a second to approve the minutes. Any discussion? Hearing none. All those in favor?
Aye.
And I will abstain because I was absent.
I will also abstain, thank you.
Any opposed? Motion carries. Thank you very much. Now we move right into number 3, our presentation from Marquette Associates for the Q2 Investment Performance Report, and Pat Wing is joining us today. Hi, Pat. All yours.
All right. Thank you, Dr. Bridget, and good morning, everyone, again. So our agenda items today largely follow suit from our earlier meeting, and again, in your packet, the book on top is the Q2 Investment Performance Report, and the second smaller book will be for our other agenda items. So with that said, I think it would be helpful probably to skip behind Exhibit 3 right now. We just walked through the market environment earlier this morning. Unless there are any other comments or questions, I'll weave in some comments based on the market environment that's relevant for the OPEB when we look at the results. But if that suits the committee, I propose just jumping into the results themselves.
Is that okay with the board?
Yes.
Okay, I think you can jump right in.
All right, great. Thank you, Dr. Bridget. So now we'll hop behind Exhibit 3, if you will, please. And you see the page number that we'll start on will be page 16. So again, starting with some high-level observations, and then we'll break down all of these observations in the data and illustrations as we work our way through the report. You can see at the top of page 16, the market value for the OPEB trust at the end of June was $118.7 million. Again, we'll have an updated value to show you all shortly. In Q2, there was an investment gain of $4.8 million. And then a return of 4.2% net of fees, slightly ahead of that policy index benchmark of 3.9. Now, unlike the LoSAP fund, as you all well know, for the OPEB, and as noted in that bullet point under the returns, we don't have the private market investment values as of Q2 yet. So in the report, they're still as of March. We've adjusted the market values for the calls and distributions that happened during the quarter, but since they operate on a lag, obviously, and they comprise about a quarter of the portfolio, we'll show you a revision when we meet next time of the Q2 return. To give you an idea of what that revision could look like, we have restated results here as well from Q1. So to further clarify what they may look like, I'll illustrate that here just shortly. But as far as, again, attribution explaining what helped the fund versus that policy index, so on a positive perspective, number one, again, a little bit of an equity overweight. As we talked about earlier, equities did very, very well during the quarter. Outperformance by non-U.S. active equity managers during the quarter. So the asset class of non-U.S. developed equities was quite a bit ahead of its respective benchmark. And then outperformance by the lone hedge fund, the long-short manager called Intrinsic, which I'll make further comments about later on in the meeting related to the decision made at the last meeting and asset allocation around specifically the hedge fund allocation. Now, on the negative side of things, a little bit of a headwind from the fixed income structure. So again, that's how those pieces fit together. The duration or the interest rate risk of the managers put together is lower than that of the benchmark. And since we saw rates came down, that provided less of a tailwind for the fixed income asset class relative to that benchmark. Now, at the same time, all the active managers actually outperformed their respective benchmarks. So we had somewhat of a headwind from declining rates, but that was almost offset by the tailwind of the respective managers outperforming their benchmarks. So if we skip ahead to page 17 and get into the data itself, again, starting up top with the summary of cash flows, we began the quarter at about $119.9 million, but a net cash outflow for expenses and fees, and then a net investment change of about $4.8 million. So all put together, the fund grew by about $4.7 million during the quarter. Now, working our way from left to right, a couple columns, again, the fiscal year to date, obviously of utmost importance here. We began at $89.3 million. Cash flows were basically neutral. So the fund itself grew by about $29.4 million due to investment gains during the current fiscal year. And as I mentioned a second ago, again, we're still waiting for about 25% of the total fund to report Q2 values. So that by no means is a final number. That's very preliminary, and we'll have those updated numbers when we get the returns from the manager shortly. If you look in the middle of the page here, again, these are returns versus the benchmark. We'll look at this in more detail in just a couple of pages when we look at the peer group rankings. So if I can draw your attention to below the asset allocation versus the target, where on the left you see all the respective asset classes, their current allocations in that next column, policy after that, and then the differences all the way to the right in dollar terms. So when you see U.S. equities, the current versus the policy, that would mean in the difference all the way to the right that we would have to trim $5.6 million from U.S. equities to get back in line with the target. But if you all recall, based on the asset allocation discussion, we're trying to improve the liquidity terms of the portfolio. So that equity overweight is actually mostly sourced from private real estate, which is the fourth line up from the bottom. So there's a big underweight there, and that target is coming way, way down because those are closed-end private market funds where your money's locked up for 10 and 12 years. So we lowered that target in the asset allocation to, again, improve the liquidity terms, and which will in turn actually improve the fees over time, since those assets will be invested in traditional assets like equities and fixed income, as opposed to private market investments, which tend to be more expensive. So on the next page, again, just a quick look at the market value history of the fund over the past 5 years. This is page 18. And you can see over time, the fund has grown, almost doubled in the past 5 years, ending at a high water mark during that period, again, as capital markets, specifically equities, have generated very, very strong returns during that period. So the favorable market environment, coupled with a strong investment program, has certainly left the fund in a very strong, healthy status as we stand here today. On page 19, again, just to give an overview of all that took place during the quarter, on the left is every single investment manager within the fund, and this continues on the next page. You see their beginning market value and then net cash flow in the middle there. So across the first 10 rows or so under net cash flow, you see a lot of negative numbers. Again, those are from the ETF managers that pay dividends and are just thrown into cash. When you get down below the last negative number there in the first 10 rows, and you see the positive $416,000, that was for the REIT ETF. Earlier in the quarter, we rebalanced and added a little bit more money back into REIT, so that's why you see a positive number there. But then down the remainder of the page, this is where the private market investments start. So again, you can see if there's a zero net cash flow, that means they had neither a call nor a distribution during the quarter. But then once you get to that negative 700,000 and below, that's again an aggregate of any calls and distributions that we saw during the quarter. And then in the right-hand column, again, since we don't have the 630 values, the net investment changes is zero because we're just operating off 331 and then adjusting them for cash flows. If you look at page 20, similar story here pretty much across the whole page. The net cash flows, again, just calls and distributions from those private market managers, and you can see the zero net investment change to the right. So if you look all the way towards the bottom, really that fifth row up, towards the left, you see Delaware Diversified Income Fund. That begins the fixed income manager lineup. There was no rebalancing among those fixed income managers, at least the top two. There was $1 million, and again, this is under the net cash flow of money added to Lord Abbett, the short duration manager. Again, they operate more in the 1 to 3 year fixed income space where there's less interest rate risk. And then to the right, where you can see the net investment change pick up again, since rates came down, bond prices went up, and these managers outperformed their respective benchmarks, the net investment change was positive there across the board. Any questions or comments from the board so far on that information before we jump into the returns themselves?
All looks good to me.
All right, so on page 24, please, 21 is just a review of the asset allocation history. 22 and 23 are just a breakdown of the manager allocations, but I'll show these shortly when we get to the update. So on page 24, again, this is the peer rankings page, and the most relevant data is at the bottom where you see the circle and the triangle. So as you work your way from left to right, where you see the circle, you can see that 4.2% return for the OPEB trust and the 3.9 for the benchmark. So 4.2 during the quarter was in the 92nd percentile, so well below the median. But again, important to recognize that we still don't have Q2 values for 25% of the portfolio. And in Q1, which I'll illustrate on the next page, the return was actually revised up by almost 2.5 percentage points, given how well that program had done. So even if we get a more conservative, say 50% of that, then ultimately we're going to be at least at or probably slightly above the median in a very conservative type of outcome for those investments.
Quick question.
Yes, sir.
Now, I see this 92, 96, 2060. What is the range? Is this 1 to 100? If I was saying out of 100, I'm number 92, I'd say, I was number 92 in the class of 100. That wouldn't sound very good.
Right, correct. So that's why it's important. This is the data as of June.
No. The point gets to be, I'm personally happy with this lower single-digit return. It shows a conservative investment strategy after we've gotten to our goal.
Right.
If I'm trying to get to my goal, maybe I'm a little bit riskier.
Right,
But
exactly.
after I've gotten to my goal,
You want to keep it?
You're right, exactly. What I believe you're getting at, Commissioner, and at the risk of putting words in your mouth, take your foot off the gas pedal, right?
all right,
Because we've
walk
had-
away from the crap table.
Right, well, which can be hard to do. But that's exactly what we're talking about here. And then with the asset allocation discussion that we had at the previous meetings, it was further, taking the foot off the accelerator, right? Reducing the private market exposures, increasing the fixed income allocation, because at the end of the day, the target return for this fund is just 6%. And if you work your way from left to right there, you can see it's way above 6% as the market's been very favorable, allowing the fund to grow in the great funded status as we sit here today. So with that in mind, as we move forward, based on the decision, improving liquidity, lowering fees, reducing the private market exposure, and upping the fixed income allocation. And that'll take time, like we talked about, right? Since those private market investments are locked up over a period of years, but marginally we'll be headed in that direction, over the next couple of years, and we'll continue to reevaluate whether or not the strategic asset allocation remains appropriate or whether further tweaks should be made. Every year we'll take a look at that. So on the next page, just quickly, again, given the importance and the sizing of that private markets program, wanted to provide you an updated look at things through March. So you'll see in the top right there under peer ranking, so this data is as of March, so it has all the revisions. But again, if you look at the bottom two rows there, you can see the return was revised up. It was 2.9%. It got revised up to 5.3%, given how well the private markets program did in the first quarter. And the ranking was 64%, got revised up to 5%. So a strong upward revision in Q1. Again, I would expect maybe not as great of a revision in Q2, but certainly a positive one as well. And then again, when we meet in December and present the Q3 report, we'll have further clarity about how the private markets and investments performed in Q2, and we'll show you the revision again to those numbers. Any other comments or questions about the returns before we look at the managers themselves? Okay. So if you would all please now skip ahead to page 28, we'll get into some details on the managers themselves, and we'll start out with the liquid or traditional managers, and then we'll spend a minute talking about the private market investments. So in 28, anytime you see a brown darker row, that is the total fund up top. So those are the returns I showed a second ago. And then the subsequent darker, more brown types rows, again, are asset classes or composites. So the U.S. equity composite is a weighted average of all the U.S. equity managers. You can see it was up 7.8%, slightly ahead of that benchmark. The first two managers there are just passive ETF funds. So just a quick couple of comments on the active managers, starting with Brown Advisory Growth Equity Fund, really the third gray row beneath the U.S. equity composite. You can see Brown was up 14.1% during the quarter, decently ahead of its benchmark, and also had a little bit more money than the large cap value index. So circling back to my comments at the earlier meeting where large growth was really the best performing segment, having a little bit more money in Brown was helpful. And then Brown, what they did specifically outperforming their benchmark, really drove the outperformance at the total asset class level. Beneath that, you see Schwab Midcap. Again, that's a passive fund. And then the two more active funds in the small cap space are ICM and Freese. Now, ICM was a little bit below their benchmark. They tend to be a little bit more defensive, and like I spoke to earlier, energy and REITs, which comprise not a big portion of the total market, but a big portion of the small cap universe, they tend to be underweight. And since those segments led the way, that was a headwind for them. But on the flip side of that, you can see Freese was slightly ahead of their small cap growth benchmark, somewhat offsetting the underperformance from ICM. Now, in the non-U.S. equity space, this is the third brown row towards the bottom of the page. You can see in aggregate, the managers returned 6.6% ahead of the benchmark at 5.2. And it was really driven, again, by outperformance of the active managers. So the first one there, that Schwab International Equity ETF, that's an indexed ETF. Dodge and Cox below them were slightly ahead of their value benchmark, so they're the international value benchmark. That's complemented by WCM, Focused International Growth. They're the international growth manager. And the latter, you can see quite a bit ahead of its benchmark during the quarter at about 10.7 versus 6.6, as they benefited very strongly from their stock selection during the quarter. On the next page, you can see similar story when we look at emerging markets composite as far as somewhat in line with the benchmark. The majority of that allocation is indexed, so that's what we would expect it to be spot on the benchmark quarter in and quarter out. Below that, U.S. REITs, again, an indexed ETF, so again, should be in line with the benchmark over time. And then finally, the hedge fund composite is composed of just that one name, Intrinsic Edge. They beat the benchmark during the quarter. They're a long-short equity manager, again, so they buy stocks they think are going to appreciate, and then bet against stocks they think they're going to go down over time. But as a quick rehash, again, when we did the asset allocation study, this is a, less liquid option than traditional assets. It's a little bit more liquid than the private markets, but the committee approved removing the hedge fund allocation to, again, lower fees and improve the liquidity terms of the fund. So those documents for the liquidation were submitted after the last meeting. They should be coming in the middle of the next month. So when we get to the next book in just a second, there'll be a recommendation about those, or an illustration about the moving pieces and the recommendation about what to do with those proceeds. So just skipping ahead to the next page, again, you see the private equity there. We'll speak to that in just a minute. On page 30, you see private real estate and high yield. We'll get to that in just a second. But below that, in the middle of the page, you see the U.S. fixed income composite. It was up 1.7%, just slightly behind the benchmark. Again, a headwind from lower rates, having a little bit of a lower duration. However, each of the respective managers, Delaware, Loomis, Lord Abbett, ended up ahead of their benchmarks for the quarter. So again, we had the headwind from lower rates, but the active managers managed to outperform their benchmark to offset that headwind to some degree. On page 31, now we have the private markets overview. So we'll start with private equity here. A lot of data on this page, so I'll focus on the key takeaways. Number one being on where you see the private markets investment overview header and commitments below that. You see the commitment, so that was the original commitment the county had made to each respective fund. And then next to that, you see the unfunded commitment. So that's what's left that the manager can possibly call during the life of each respective fund. And if you work your way all the way down to the bottom of those respective columns, you can see the total aggregate commitments is just shy of $20 million, but what's left unfunded is about 4.1, so only about 20% of what's outstanding. Now, importantly, this is as of March. So there was a improvement to JMI Equity Fund 10 made last calendar year. Those documents were executed. So that fund began starting to call capital post Q1. And then if you recall, at the last meeting, the board approved a commitment to Accolade Growth 2, which is a name in the portfolio that has done quite well before. So that unfunded commitment is reflective of that, since the money hasn't started to be called yet. But circling back to our review of the private markets program, we had sort of estimated that about $2.5 million per year is sort of a sweet spot to continue with the program, because it's worked so well, but also improve the liquidity terms over time. Because even though we're committing more money, since the program's very mature, more of it's going to be returned to over time. So we would expect, some level of commitment, but in any given year, more money than that being returned, and then over time, the allocation to go down to improve the liquidity profile. The last key takeaway, if you look all the way to the right on the bottom there where you see 24%, that's essentially the return of the program in general. When you make an investment in private markets, you want to be compensated for the risks, specifically the illiquidity. So this is an equity substitute, and if equities return 10% over the long term, you would hope for something kind of in the neighborhood of 15, 16%. So this program has actually done quite well during this period at 24%. And like we talked about last time, the big drivers around that were the large allocation of venture capital funds, growth equity funds, the former, which tends to be pretty risky, which makes investments in companies very early stages of their life cycle. Growth equity a little less risky. And then the least risky part of the market is what's called, small buyouts, where funds are buying smaller companies and businesses, but that have been established, that maybe have $250 million, $500 million in earnings and EBITDA or cash flow. And as we progress with this program over time, not only are we going to lower the commitment amounts to improve the liquidity, but from a risk perspective of what's in the fund, we're going to be focusing on more funds on that buyout side that, relative to venture capital and growth equity, a little bit more certain based on the underlying companies that these funds are investing in, much more mature along the stage in their life cycle from a business perspective. So on the next page, just quickly around private real estate, again, looking at the commitment levels here, you see about $10.5 million in total commitments. About $3.4 million outstanding, so about a third of it still left to be called. Again, for the asset allocation, this target is coming down from 10 to 4%. Okay, so we're probably not going to have any recommendations about new private real estate commitments for some time because the current allocation is above 4%, and we still have a decent amount of commitment left to be called. So we'll continue to review this like we did last time with the private equity about what's appropriate, but I don't foresee us making a recommendation in this program maybe till the latter half of next year. When you look at that IRR again, all the way to the right, just a shade under 13%. Again, that's in line with what we would hope for, relative to the public markets, public real estate generally, similar to equities in the 9 to 10% range. So being compensated a few percentage points above that for, tolerating the additional risk, tolerating the additional illiquidity, excuse me. And then finally, on page 33 here, now we're looking at the last segment of the private markets program, specifically private debt. From the commitment perspective, much of this has been called. There's only about, call it 25, 27% outstanding of an unfunded commitment relative to the total commitments. This target is also decreasing. If you recall, it was 4%. We're moving it down to 3%, again, to improve the liquidity terms and profile of the fund itself. And then if you look all the way to the right again in that IRR, in the private debt space, obviously, lenders aren't nearly as compensated as much as equity owners, but we would hope for a return in here really between 8 and 10%. Because as owning fixed income of sub-investment grade fixed income, the general long-term return is probably about 7.5. So we've been compensated by about 2 to 2.5 percentage points by taking the additional risk as I outlined for the previous asset classes. So long story short, each of these programs continues to do well and help the fund from a funded status perspective, from a health perspective. Again, we'll be looking to draw down these allocations over time. Doesn't mean we'll stop making commitments, but we want to be thoughtful about the size of those and the specific funds that we're recommending for the board within each of these respective programs. So with that said, again, let me pause quickly. I just wanted to make one more comment around fees in a second here, but happy to address any comments or questions from the board around that information.
I just would say, make sure you identify what the source of for these unfunded commitments, where that's coming from. I would assume we're going to sell something and buy something.
Well, what we have done historically, Commissioner, and one of the changes that was approved is it comes out of cash. So even when this money is going to be called over a year or two, at the same time, we have a lot of money coming back into the program. So it's almost cash neutral or
revenue neutral.
Yeah, pretty much. So there's nothing, the timing doesn't match up perfectly, but in any given month, I wouldn't expect, $1 million to be drawn.
Okay, so we're keeping around $3 million in cash now.
Correct.
So we're keeping with that about 2.6%. Now, we have a policy of 0.
Now, but if you recall, based on the size of the program at the last meeting, the target was
going to
2%,
yeah,
right?
okay.
So just to be safe around the mechanics of how those programs work, we think it's, again, more prudent to have an actual target to cash.
All right.
So just quickly then on page 36, and we'll wrap up here and jump into the next book. Again, from a fee perspective, you can see in that blue line there below, the estimated annual fee all the way to the right of about 62 basis points. So that's on the higher end. Typically we see things more in the sort of 45 to maybe 55 basis point range. It is set to come down shortly with the liquidation of the long-short hedge fund manager. That's at about 1%. So when we meet next time, I expect that to be a basis point or two lower. Over time, as the private market allocations come down, that'll come down as well. And it's important.
I'm sorry to interrupt you.
Oh, yeah, absolutely.
Kind of like making my wheels turn. Yeah. So was those generated on past commitments that we had that were longer term and that those terms are finally coming to sunset?
For which specifically?
Well, when you talk about reducing these, when someone says 0.62 is high, I use the term, I don't know what I don't know. If like that guy sitting next to me out there at the restaurant was telling me, hey, look, you should be a lot lower than this. So what you're saying to me is that 0.62 is going down. It should go to 52 and hopefully lower. But the reason it was where it is now is because we were in investments that had a lifespan or a longer-term lifespan, and those lifespans are coming to a sunset?
Right, exactly. So
I got it.
the size of of those private market programs really drive that number, but as they mature and come down and we're able to lower the target to those asset classes, then that'll filter through here as well.
Okay.
So over time, it'll come back down, but at the same time, it's important to recognize that all of the returns that have been generated over time are net of these fees as well. So they take them into account. So
That's good, too.
yeah, right. So they're not gross. They take into account these fees themselves. So again, with that said, as I mentioned earlier this morning, we are happy to add additional line items here showing our fee and the custodian fee, which for the LoSAP and the OPEB fund are basically non-existent right now, but we can show that as line items if the board would like that moving forward.
Yes.
I think you have consensus of the board?
Yes.
Just to add those, that's great.
Real
Thanks.
quick question, though, on this Roblox thing.
Yes, sir.
My granddaughter still keeps buying a lot of Roblox, or her grandmother keeps giving her money to buy. Are those guys still kicking butt? I mean, are they still doing well?
I actually saw the price of the security this morning from when I was at the hotel, and it basically has been unchanged
Okay, good.
over the past few months. I mean,
Say it that way. We didn't get out at the wrong time.
no, and importantly too, Roblox is an individual security, right? So we do not do individual security analysis. It's atypical for one of these funds to distribute an actual security. Normally it's cash, but when it does happen, we would always make that recommendation just to liquidate the fund as fiduciaries, the requisite knowledge to do a full detailed analysis of an individual company and their income statements, financial statements, is just not something that we would be comfortable with.
I shouldn't even brought it up.
No, it's fine, but it's been more of the same for them over the
I
past.
told my wife we sold the stock, so she don't have to give my granddaughter so many. She gives like $20 a week or something put in this.
It is amazing.
It is amazing.
I don't want to say in a public meeting how much my son spends on it, but I digress. But so that wraps up my comments here on the performance report. Again, happy to address any other comments or questions from the board at this time.
Are there any other comments on the Q2 report? If not, we'll entertain a motion to approve.
I'll make a motion to approve the Q2 report.
I'll second it.
We have a motion and a second. Any discussion? Hearing none, all those in favor?
Aye.
Any opposed? Motion carries. Thank you. And then that, Pat, shifts us into the asset value update, I believe?
Yes, that's right. Thank you, Dr. Bridget. And I think we'll be able to work through this book a little bit more quickly than earlier, given our discussion. But if you would hop behind Exhibit 1, please.
Exhibit 1? Oh, yeah.
Yes, behind
the other book.
Oh, yes, I apologize. Yes,
No,
this
that's all right. I got it.
in the other book, the shorter book here. So, and we'll begin here on page 4. So a couple of highlights as you all make your way to that page that I'd like to draw out. Number one, if you look at that second column there where you see total assets, so the fund, as of about a week ago, was just a shade under $119 million, so it grew by about $250,000 since the end of the quarter. Again, markets have been mostly flat since then, the last week notwithstanding where we've seen a decent rally. The other quick thing I want to mention, well, actually two quick things, my apologies, around the recommendation itself. When you look in the rebalancing column in the middle of the page, and specifically where you see the negative $2.23 million towards the bottom, so that is the redemption coming from the hedge fund. Those papers were executed and submitted, and how it works is essentially they ask for 30 days notice, so we got them submitted prior to the end of July. So 30 days would be
They're due any day now?
the end of this month. And then a couple weeks after that, we would expect the money to come back. But as you'll notice, that 2.23 is not the exact amount of the value now. And the reason behind that is they return 97% of the value of the fund, and they hold back 3% until their annual audit is complete, which we would expect to happen in Q1 or Q2 next year. And at that time, that remaining $68,000 will be sent back to the trust. So what we have under consideration is now just 97% of that liquidation, which again, we would expect to happen by mid-September. So with that cash coming in, but being a little delayed, you can see we have about a little under $2 million in cash right now. But our recommendation, given that cash that's going to come in, using about half of that to add $1 million to the Lord Abbett Short Duration Income Fund for a couple of different reasons. Number one, we're still overweight equities, like we talked about at the end of Q2, still overweight today. Again, that's largely funded from the private real estate, and that target is coming way down. So that's essentially where we're moving to over time. And related to that, given that interest rates have dropped rather notably over the past really 5 or 6 weeks, that manager within fixed income, again, has a shorter duration. So they operate in the 1 to 3 year space. So if rates do climb, then when we think about, again, the fixed income pieces put together, that would provide a little bit more downside protection for that part of the portfolio if rates do rise in the coming months or coming quarters. The last thing I want to mention before the board takes that recommendation under consideration, if you look in the first column, under U.S. equities, about 5 lines below, you're going to see a new name there called William Blair Small Cap Value. So as a quick review, earlier this year, we took a big look at the U.S. equity portfolio, international equity portfolio, and made some recommendations. And one of those was to make an investment in a firm called the Investment Counselors of Maryland, located out of Baltimore. It was a small cap value firm. They've recently been acquired by William Blair, who is a firm out of Chicago. So with ICM for short in the small cap value space, basically what's going to happen is just new branding. So what they're doing is they are now taking over the small cap value franchise under William Blair, but it's the same team, the same process, same strategy, and importantly, from ICM's perspective or their team's perspective, they're staying in Baltimore. So there's not going to be any sort of, huge change in uplift, which could actually increase the opportunity of some changes around the investment team. So what they've told us was going to happen has happened so far to this point, but I wanted to outline that as, it looks like a different name, but it's the same strategy that was previously approved, the same team and the same process itself. But it's something, anytime you see a big acquisition, we monitor extremely closely. So I'll continue to update the board on the progress of that acquisition, and obviously we'll be reviewing performance regularly as well, but I wanted to bring that to your attention today. Any questions or comments around the acquisition before we consider the recommendation on the next page?
Don't follow it up.
I'm sorry?
Don't follow it up.
Understood. So on the next page, this is again just a summary of our proposed actions today. So you see the bullet, our recommendation for the proposed rebalancing as shown on the previous page. It's summarized below, just adding $1 million to the Lord Abbett Short Duration Income Fund. That will be coming from cash, and then obviously in a few weeks, the hedge fund money will come in and basically refill the cash bucket. So with that, again, let me pause for a second.
I'll make a motion to rebalance the cash from $1 million into the Lord Abbett Short Duration Income Fund.
We have a motion on the floor. Is there a second?
I'll second.
Any discussion? Hearing none, all those in favor?
Aye.
Any opposed? Motion carries. Thank you. Anything else on the asset value update?
No, Dr. Bridget.
Okay, then our next item is the investment policy statement review. Pat?
Yes, thank you, Dr. Bridget. So just quickly, and this is behind the next exhibit in the book and on page 7, but it's a reprint around the materials earlier that we saw from the LOSAP report. So based on our discussions, just as a quick review, if it would suit the board, I think we should follow a similar plan here, meaning that at our next meeting, bring the old statement the draft, walk through the key differences, and then in the interim, if any of the board members have specific comments, suggestions, changes, if that you could pass them along to Ms. Kwasny, and I will be sure to circle up with her and compile them, and then we can have a larger discussion around the IPS at that time, if that would suit the board.
Is that comfortable for the board, for that
Yes.
process for next time? We have some homework to do.
Yes.
Thank you.
Thank you.
And then next steps for us, Pat?
Yes, and thank you, Dr. Bridget. And again, this is largely in line with our discussion earlier today. So again, at the next meeting, please ignore that first bullet point as the investment policy being finalized. We will.
What page you on?
I apologize, Commissioner, page 9.
Oh, no, okay.
As far as the investment policy statement is concerned, yes, we all have homework and marching orders as it relates to that. We will also have some recommendations as normal. One of them, a little bit different than the LoSAP fund, as far as the new asset allocation that was approved, if you recall, was an allocation to infrastructure was approved. So we'll be taking a look at that. We'll bring some options for the board to consider fulfilling that mandate. Obviously, we will have a recommendation, but in an effort to be prudent, we'll show the board a number of options, and we'll walk through the key differences and the pros and cons. So just wanted to outline that, as it's a little different than the LoSAP fund, obviously. And then as far as the custody RFP updates, similar story as outlined earlier by myself and Ms. Pratson. So with that said, that wraps up my prepared comments today, but again, happy to answer any other questions or address comments from the board.
Great. Any other comments or questions for Pat from the board? Okay, thank you very much.
Thank you.
And next on our agenda is committee reports, the plan administrator's report, and I'll turn it over to you, Jody.
Thank you, Dr. Bridget. For the plan, since our last meeting, the plan has sent capital calls totaling $813,666.54, and the detail for each call is listed on the written plan report. The plan has sent out fund expenses for Marquette Associates, $27,163.05. For the calendar upcoming, our next meeting is scheduled for December 3rd. And at that time, we will have on our report our proposed meetings for 2022. And if the board would like, we can take into consideration meeting every other month, as discussed in our LoSAP meeting.
What's the pleasure of the board for your meeting structure, quarterly or every other month?
Every other month?
Every other month.
Go to our 6, okay. Great, thank you, Jody, for the suggestion, and so we'll entertain that in December. For today, are there any questions on the plan administrator's report? Hearing none, we'll entertain a motion to approve.
I'll make a motion to approve the plan administrator's report for August 27, 2021.
Thank you, is there a second?
I'll second.
Any discussion? Hearing none, all those in favor?
Aye.
Any opposed? Motion carries. Thank you very much. And that wraps up our meeting for today. So if there's no other agenda items, we'll entertain a motion to adjourn.
So moved.
Is there a second?
Second.
All those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you very much.